American AI giants like Alphabet face fresh tests. Hello, and thanks for joining us today. The headline is, of course, American AI giants like Alphabet are facing fresh tests. It's a headline that packs a lot of meaning. Silicon Valley's big players are being challenged by new, powerful AI models coming out of China, and it's happening just as Alphabet is set to ring in its earnings this week. For context, the AI trade that has driven a global rally. Interpolate and pumped equity markets for years is hitting turbulence. The buzz started when Moonshot AI released its latest model, Kimi K3. In a handful of benchmarks, it nearly bested Anthropic's Fable, and it's free and open source. The effect was immediate. The internet was buzzing, the model was down for a weekend, and Moonshot had to adjust its subscription plans. Iberhood. Alibaba, too, is in the mix. The day before Sunday, they announced a preview of Qwen, another big open source model that performs comparably to Fable. The news was enough to lift Alibaba's Hong Kong-listed shares by almost 4%. These two events are more than just products, they signal that open-weight models are suddenly matching, if not surpassing, the street-tested closed systems that U.Shelf companies have been building. Because of that, the broader market is reacting. Korea's Kospi slid almost 4.5% on Monday, driven principally by memory chip makers. SK Hynix fell 4%, while Micron and others also had off days. The PHLX semiconductor sector index also took a hit, falling 1.6% on Friday and dropping 10% for the week, its worst weekly decline in over a year. These market moves raise a key question: do the massive AI spending plans announced by hyperscalers still make sense? Alphabet and Meta, Nvidia, SK Hynix, and the like all spend heavily on the premise that pushing the envelope in AI required outright dominance. The idea was that they had to run the largest models, the biggest teams, and the biggest dollars to stay relevant. But now we see that Chinese developers are offering open-source, free-to-use models that are achieving similar performance. That could shift the entire cost equation. In the end, the industry might look more indebted than it can justify if it continues to burn through billions just to keep pace. The stakes for Alphabet are high. Its capital expenditure forecast last year was in the $180 to $190 billion range. The company now faces a dilemma: keep investing at that level and risk being outpaced, or dial back spending in search for efficiency. Alphabet's earnings report on Wednesday will likely reveal how it's planning to navigate this new landscape. Beyond AI, global markets are still jittery. Oil prices are holding up amid the war in the Middle East, and the S&P 500 futures are nudging higher. Even in the midst of geopolitical uncertainty, investors are watching Alphabet's financials keenly because they're a bellwether for tech-heavy, growth-oriented portfolios. So what should we watch? First, look at Alphabet's guidance on capital expenditures. Second, case note whether they are adjusting their product roadmaps to leverage these new open models or if they are doubling down on proprietary research. Third, keep an eye on the downstream impacts on memory chip and GPU markets, because those supply chains are tightly linked to AI workloads. In the coming weeks, we expect Alphabet to comment on the rise of open-weight Chinese models and on how that will affect its strategy. Whether the company will shift its forecast, or whether it combination height the heavier lines, remains to be seen. Thanks for listening. Your curiosity fuels our discussion. Keep coming back for more analysis on the ever-shifting world of AI and tech finance. See you next time.